Well, if history has a habit of repeating itself, then it also provides a way to learn from the experience, correct past mistakes, and capitalize on opportunities unseen. Ever since the financial crisis of 2008, markets have been as resilient as a rubber band. They stretch to the limit, and just when you think they might break, they pull back to stability. We are now in the midst of a multi year pandemic, which has caused markets around the world and especially India to test their durability more than usual. Last year, the BSE Sensex crashed over 1,000 points 14 times, with the biggest sell off at nearly 4,000 points coming in during the Ides of March. Fast forward to February this year, and we see markets reaching all-time highs and still relatively holding their heads above water despite concerns over an economic revival. The silver lining is that investors now have the tools to navigate these choppy waters effectively through the vehicle of mutual funds. Smooth sailing involves rule-based investing, timely course correction, and a high level of transparency in fund products. But the bigger question remains: how do investors make sense of this new normal of volatility and position their portfolios to deliver on their life goals even when the tension of opposites stretches the rubber band of markets to their limit? That's what we are here to find out. I'm your host, Gautam Srinivasan, and in this special episode of Mutual Fund Mantras, I'm delighted to speak with A Balasubramanian, Managing Director and Chief Executive Officer at Aditya Birla Sun Life AMC, to help us all gain some insights into this vast universe of mutual funds with an eye on India's economic growth prospects. Bala, great to have you with us on Mutual Fund Mantras. You have nearly 25 years worth of experience in this industry. So you come with a very interesting vantage point, and which is something we all want to first see from when we look at the markets. We have seen volatile periods earlier, but today many are trying to make sense of the fact that while clouds hover over India's economic growth prospects, equities seem to be basking in the sunlight. We're near our peaks back again. What is your reading of the current situation, considering your experience of past volatile periods?
Thanks, first of all, Gautam, for having me part of this show today. I think, as you rightly said, the 25 years of experience in the mutual fund, one thing what has learned that has remained permanent is the one change. While the change keeps happening, the continuous optimism that one has to hold in the market on the basis of hope, on the basis of some expectation that is certain, that is again remain constant. And why I'm specifically saying this is that today we are all cherishing about the 50,000 index that has touched new high. And in fact, the beginning of the financial pandemic, rather, I would say, the financial year, April 2020, not many would have expected the way I think markets have come back. Not many would have expected saying this kind of market movement will happen. And that's what historically, if you see, a similar trend has emerged. I think when I used to see the market in the early 90s, the early 2000, even the latter part of 2000, which is basically 2008, 2009 crisis, I think every point of time, if you look at the market initially would have gone down, and subsequently on the basis of the expected earnings, expected growth that could come, and the markets always bounce back. I think what we're seeing today, and that's what it reflects that. Therefore, the market, when it goes through a cycle, clearly every up market like this, what you're seeing, we have to make a clear understanding that will also go through some downside. But again, I have to have a confidence that the same market it falls will come back. And that's where the new highs are always made, the ups and downs in which it goes. I think what has remained constant is actually the upward path to it remains constant, but we have to go through the volatility period. That's what I see something in the stock markets have existed. And what I've seen in the last 25 years is what exactly I've seen. And that's something even going forward will remain.
So do you think the real economy has to catch up to the market's optimism from here on? Is that what's happening here?
Yeah, I think the optimism will come from 2-3 counts. One, first of all, the optimism has to come from the growth expectations. Basically, the consumer buying behavior has to change. Product that you produce has to be sold month after month in a higher number. And the spending habits of people have to keep going up so that the demand for goods are created. As a result of all these things, the companies are able to sell more. companies are able to make more profit. This comes actually in every cycle it comes. And where is it linked? Actually, it's linked, of course, to the GDP growth. And the GDP is something, if let us assuming the overall GDP grows by about, say, 6.5%, 7%, then again, inflation, if you add it up, is about 11-12% kind of GDP, nominal GDP, if you have to take. In general, the assumption is always made the companies will grow in excess of nominal GDP. So that's why I think we are looking at. Basically, the power of compounding, what we normally advocate for investing in mutual fund deposits or anything that we have, power of compounding is a simple methodology that we use. The power of compounding also works for even optimism building also. Therefore, the growth expectation always drives the market, drives the sentiment. That's where optimism comes. The second, of course, is being driven the way the regulator functions. The way basically Reserve Bank of India is one of the institutions. I've got the power of printing money, right? So today, the money that is lodging in the system is substantially higher than the past that you have seen. In the sense, never in my own stock market experience, the kind of money that has been printed this point of time has never happened in the history of the last 25 years. So that's something you can never underestimate. Maybe that is where optimism comes. What actually makes the optimism to stay for longer is the kind of money that has been pumped in ultimately has to lead to the growth come back. Once the growth comes back, the earnings starts coming back. That's a cycle in which you will move. So therefore, the first comes with the hope and optimism. Then comes the growth phase. Then comes with the consolidation. Then comes actually the higher trajectory of growth.
But as we transition from the growth phase, that is the bigger question. The reference to growth always brings with it the reference to inflation. It's kind of like that movie Diwar. You have on the one side growth and you have on the one side inflation, and there's always a battle between both. And that's another key issue. It's a key part of the debate. And while the central bank might have favored growth, the problem now is that wholesale price inflation has galloped to a 11-year high of around, I think, 10.5% in April. The worry is how much firepower now remains with policymakers to contain such flare-ups. And of course, what will be the effect on India Inc. So from an investment perspective, what's your prognosis of the situation? Is it a good time to increase your investments in the current market? How would you play?
See, inflation again is a function of supply-demand situation that exists in every commodity that operate. So today, the commodity prices, unlike the last 1 year, commodity prices, especially metal prices, have gone up quite significantly. And that again, if you see, agri-commodity prices are more stable or marginally higher. And then we go through this cycle. This is demand-supply situation. And today, the demand could be higher and supply could be less. And that's something that goes through the change every now and then. So if the inflation is good, at least for a company that are producing goods, it's actually more better for them, for profitable. Therefore, there are certain sectors and markets, participants, of course, there are certain companies do get benefit out of high inflation. There are the user industries of such same metals may go through actually a pain period. For example, auto as a sector do consume steel and other commodities. Construction sectors do use cement and other commodities. Therefore, the input cost would be relatively high. Therefore, what is the absorbent capacity of the system? So high inflation should also have some kind of absorbing capacity, like you and me as a consumer. As long as the absorbing capacity remains, then absolutely no need to worry about from the market point of view. The question will come only when absorbing capacity comes down, because the earnings going down for us as a consumer. And therefore, that actually reduces the demand supply as the equation something different. Then naturally it will have an impact on the stock market.
But that brings me to the point of, the issue would be if, say, there is an unleashing of demand, the pent-up demand which comes. The problem which some might see is there supply capacity right now, considering a lot of the firms have undergone issues in terms of staying afloat in this time. So, do you see some structural reforms helping the economy recover at a faster pace? And more importantly, plug holes from the supply side of the equation to ensure that there is parity.
Yeah, I think clearly if you look at Gautam the last 4 or 5 years, because the excess supply was a period, thanks to the capacity that got built up in China, the slowdown for about 1 or 2 years. Therefore, the excess capacity had to be unwound. And there was a process of unwinding of excess capacity, and therefore that brought in stability. Then today we are in a scenario that capacity is only so much available, but the demand is picking up mainly because the government worldwide has been printing money and ensuring they make huge amount of investments in building infrastructure in order to create the demand. And that kind of thing, whenever it happens, the demand gets created and steps are being taken by the regulator, especially the government, is something which I think is the biggest spender for reviving the economic growth back, whether it is in India, whether in China, or in the worldwide like US. Now they're spending trillions of rupee, trillions of dollars, sorry, to invest in infrastructure building. So the moment that comes, naturally, your expectation of the demand for certain commodities go up significantly. Therefore, the first price improvement comes, then actually the demand comes in, and there's a cycle in which you are going in. Therefore, that is being the case. My own gut feeling is we'll probably in a cyclical, long-run bull market, especially in the commodities space. And given the whole the push that's coming from global economies, especially in the developed economies, is going for reviving the economic growth. Therefore, one of the sectors where probably we would see a significant sudden demand comes in, especially in the construction capital goods sectors, whose product probably would not have been demand for the last 4 or 5 years. Suddenly the demand is coming in. So that's something which I see is a change in the way forward, which is the government spend led, rather government spending led growth coming back. And therefore that will probably be pushing certain segment of the market, which otherwise cyclical nature. That cyclicality would have lived in a very short period of time. Now it looks like on the basis of this, maybe those cyclical sector will have probably a longer life cycle, which it probably do not have seen in the past.
That actually ties in well with my next question, which is around the theme of the return of the old economy stocks, because we see healthcare as a space now as a great investment option. So are logistics and supply chain related companies. That's something Manish Dangi had also said that he's positive on. But how should investors read sectors which are currently in distress? That's my question, and especially around autos. If we are in, say, the initial stages of a new economic and earnings growth cycle, would corrections from here on be an opportunity to buy old economy stocks, which includes PSU, which have found favor again? And which sectoral themes would you prefer in that case, and which would you avoid?
See, naturally, Gautam, if you look at from a market trend point of view, the initial phase market always chase the growth. Any company that has got a high growth, the growth companies get chased, and therefore they basically drive the market sentiment. Upon growth companies reach a certain level, which is say high pay multiples, beyond that, probably there will not be any more room for the companies to do well. Then comes the value theme. So which basically companies have not been recognized trading close to the price to book multiples, or maybe the companies who are old, old economic kind of companies have remained part of the market but got ignored for multiple number of reasons. And those companies get suddenly recognized. I think we are at the stage, definitely the value companies would probably get a preference over growth companies. And given the fact that the valuation is cheap, and especially the market which is already trading at 50,000 index, it also one has to assume that probably some bit of volatility if it sets in, which are the companies can also help me in protecting the downside. So that's where I think the value companies come into play. And also the old economic companies, especially like automobiles, or maybe we can even say the commodities companies, they of course gain some kind of significant added advantage given the fact that once the demand comes back from the consumers, especially when interest rates are low, those sectors are also beginning to participate. That's why I think the market goes through the cycle. This again, historically, I've seen the market is a good mix of growth at some point of time, then the value, then come back to the growth depending upon how the valuation moves. I think we are at a stage, as I mentioned, value companies generally is considered as more preferable than the growth companies as it stands today.
All right. Looking more at the debt side of the equation, one could say that the RBI has embarked on a quantitative easing via the government securities acquisition program. But if this is uncharted territory, as the central bank resorts to being purchaser of the last resort for government bonds, while on the other hand, we see credit growth still hitting a new low for a second year in a row, what should be the long-term strategy of investors in the debt fund space?
See, the debt fund is something will remain, the way I see, is part and parcel of everyone's portfolio. But this is the balancing factor. In anybody's portfolio, when I look at mutual fund, You need to have a good mix of equity to provide the longer term growth. And you need to also have a good mix of debt, which can give you a stable return. As the fixed income is more like a linear growth that you get, as an equity you get ups and downs kind of growth, so it can balance it out. And having said that, where we are today, as you rightly said, credit growth is not picking up. The banks do not need any more money, big time money, to offer them a higher rate of interest to rise the deposits. Therefore, from a saver's point of view, is going to remain a challenging period of not able to generate enough return from bank deposits. Therefore, they have to, of course, migrate to the mutual fund fixed income space in case they are the ultra conservative investors. But having said that, the mutual fund has got one beauty. The sense that in fixed income assets, there are two components of fixed income schemes. One is interest accrual. Second is the market price fluctuation. The price fluctuation, depending upon the RBI move and the fiscal deficit, how the government is going to borrow, and how much the private sector is going to increase the capex. Therefore, they are going to come to the market for borrowing. All such things, inflation going up, all such things determines the bond price movements. I think in the debt funds, of course, when you go through the cycles, so today the low duration funds, when I'm talking about your fund investments, 1 to 1.5 years of duration, it invests only for 1.5 year duration. You have to make an assumption at the end of 1.5 years, they will start reinvesting the money for another 1.5 years. So as a result of that, the recycling investment that happens in fixed income generally tend to create a better experience with investors in the long run. But one thing, of course, one has to keep in mind, the mutual fund, of course, it reflects the interest rates moving down in the return, and interest rates when it moves up also reflects on the return in the form of creating some ups and downs. But if I give a cycle of, say, in a 5-year or 10-year cycle, the fixed income generally gives a reasonably good experience to the investor. That's why one has to look at fixed income schemes.
Right, but what about the spikes which we saw in the middle of the 10-year yields, right? That always puts someone in a frame of mind that even in this space, while folks would prefer a sort of a stability in terms of cycle, we are seeing those aberrations coming. What would you say to them, to the investors who look at those spikes and wonder, although 10-year yields are in a relatively comfortable place right now, but is it the calm before the storm, or was the yield and spike just an aberration in your opinion?
See, I think unlike the past, Gautam, where the central bankers are a lot more under control in managing liquidity, managing any kind of volatility that sets in the bond market, by way of constant intervening, and also knowing very well fiscal deficit will remain high till such time the growth comes back. So that has been the case. The bond yields that spike that comes in, you'll see the volatility in the bond market is much lower than what is in the past, given the fact that central banks have been intervening in controlling the bond yield curve, which in my view will stay for some more time. Now, everyone globally, the thought process has now got converged not to look at inflation as single point inflation, look at the average inflation, and not look at the high fiscal deficit as a concern, given the fact the government everywhere is going to be the largest borrower, not you and me as a private sector, or maybe you as an individual. And that has been the case. You'll probably see very smooth the transition from a low interest rate regime to relatively a marginal higher interest rate regime. But that will be happening very gradually without giving any kind of surprise on the negative side.
All right. So we've been discussing around broader themes of economy and market. Let's look at investor habits as well. There's always the debate of, say, passive investing via index funds versus active investing routes in mutual funds. It's an age-old debate. Where do you see the trends headed to in terms of investor habits, especially as more and more retail investors start to invest in mutual funds during the pandemic as a route for wealth creation, with many investment apps and services that have made it accessible? Many wonder if they should just invest in index funds and let the market do its magic. What's your view on this?
I think the way I see is, I think India especially will remain a broad market opportunity that comes, in the sense that moving away from 30 stocks, or Sensex 30 or Nifty 50, the number of companies in the listed space is very, very large. As you go down other than this 50 companies, 30 companies, the opportunity that can generate and then the way it can give a multiplier growth that can come is quite huge. Therefore, index fund from India point of view, while it could remain as one of the alternative, so I'm not saying index fund should be avoided completely. An index fund can become one of the complementary product to the existing product. At the same time, the existing funds which has been trying to generate alpha using good mix of large cap and mid cap and small cap, and that will provide still an opportunity for money managers to generate alpha over the index funds. And that's something what we have seen in the last 1.5 years. Again, if you see in the last, especially 1 year, it also got reversed. Then we need to also make an assumption that few large companies are part of the Sensex and Nifty who drive the market also will go through a plateau period. That is when the rest of the market will begin to perform. That's why if you see this year today, Nifty has given 60% return, whereas small cap mid cap index has given 100% return, 120% return for the last 1 year. We will go through the cycle always. You go down the market cap, the probability of making more money is high. Of course, one has to just remember it comes along with some kind of volatility. So that being the case, index fund and the passive fund strategy, one has to look at as a complementary to existing product, rather than that's the only way of investing going forward, and ignoring completely the actively managed funds.
All right, but extending this conversation to include asset allocation, if investors want to beat the cycle and get great returns, the question is, strategic asset allocation, it's great, it's sound in principle from a long-term perspective. But considering the volatility being seen these days, if the economic cost of pandemic impacts corporate earnings as, say, curbs get extended or imposed in new areas, do you see tactical asset allocation by the average investor gaining more momentum? And if so, what are the do's and don'ts you would advise?
Yeah. See, clearly, I think we should not call it the tactical asset allocation. It's actually a principle of the discipline that one has to have an asset allocation between equity and debt. And whenever the past returns on one asset class is substantially higher than your expectations, then naturally one has to do some kind of allocation, reallocation of that assets to some extent to move into the, say, fixed income and equity. And that has to, and also including some amount of gold as an asset class in that space. I think that something has to be part of the discipline. The way I actually advocate to most of the investors, you start with a 50-50 kind of model, 50 towards equity, 50 towards debt. And depending upon what is an expected return that one can get on each of the asset classes, and increase your weightage on the basis of expected return. And then you keep rebalancing it. Expected return, what you decide today, need not necessarily the same return after, say, 3 months, once you have achieved your target, right? Or maybe your next 1 year. Therefore, the constant rebalancing by marginal tinkering here and there between the equity, debt, and gold is something can remain as a permanent 10-15% or something. So that's something as a model if you apply, an asset allocation will actually deliver much better results. And having said that, suppose individuals are not able to do that, then definitely the funds that some of us are offering, like balance advantage fund kind of model, could also be taking care of that benefit, because money managers would carry the asset allocation, which otherwise the investors would have to do in their own day-to-day portfolio management, by moving asset from equity to debt, and within equity from large cap to multi-cap to mid-cap. And that's something he'll keep doing it on his own model. Therefore, there's another way actually investors can also choose such kind of options if they don't have time and wherewithal to do the asset allocation by themselves.
All right, let's dig deeper into that question. What would be your advice to investors in terms of determining whether to stay with or sell a fund? Because the habit of tinkering a portfolio might not go away, and the question always remains in someone's mind, because while past returns are not indicative of future performance, they've heard that there is still an element of fund shopping at play in the minds of investors. And the problem is that funds are expected to outperform on a short-term basis, even though equity is a long-term game. So what would you say to this?
So I think this hopping from one to other generally does not really give a benefit for one simple reason. If somebody is underperforming, say for the last 1 year or 2 years, you suddenly assume the underperformance is going to continue. The only time that you must make the money move from one to other, only when you lose the confidence of either the fund house, or when you have you lose the confidence of the money manager who is managing funds, or when you lose the confidence of the fund, the scheme itself, where the scheme cannot afford to deliver because of constraint that may have a better return going forward. Because every fund has got a constraints. I'm just giving examples. You'll probably a cyclicality fund, like from a capital sector fund. It will always do well when the capital sector as a sector does well, like infrastructure fund. And you can't blame the infrastructure fund has not done very well today. Therefore, I'll move out, because it's a cyclical nature. I think as a fund, you have to also keep in mind. I think that's a principle if we keep. I think you don't need to actually hop your investment, move your investment one to other on the basis of underperformance. But then what will happen is you'll probably miss the opportunity. Otherwise, you would have gotten the same fund by staying invested. And that's something one should not forget.
All right. And we see the universe of mutual fund products expanding, absolutely. But in terms of broader investment products, we also see the universe expanding with providers now offering small case investing options, which is basically a basket of stocks that may reflect a particular investment theme or an idea or a sector. You mentioned infrastructure as an idea. Maybe there's a small case investing idea there. Now, many were quite excited with such things. They're excited with prospects of, say, cryptocurrency. And, well, we saw what happened with the recent crash. So from a long-term perspective, especially through the lens of risk, why should investor still consider mutual funds the gold standard versus these new investment products which offer more control to the average investor, but they also entail higher risk?
I think interestingly, Gautam, one of the principles that which I like as far as the mutual fund concerned, the diversified nature of the fund makes it much more safer in the long run. Given the fact that the market goes through a cycle, and as you took the example of cryptocurrency, it of course did well. It also goes through a volatile period. Sometimes existence of some of these companies could also come into a question mark. Whereas when you take the diversified portfolios, the mutual funds, even if assuming a scenario we make mistakes on buying certain companies, which disappears tomorrow, but assuming the company disappears, therefore you lose your value completely. But still, the value loss in an overall diversified portfolio is only small. Okay, that's again, it's again shared by money. Therefore, the loss actually is shared by money. The gain is also shared by money. Therefore, it actually gives you some bit of a better experience over a long period of time. When you go for a basket, then you must understand the basket of securities, which is done very well today. At the same time, any risk associated with that kind of basket, because the basket remains constant, risk can come and go. When the risk suddenly comes and actually hits, the basket can also equally do badly. At that point of time, what do you do? Would you curse yourself? Or that's the point of time actually to look at diversified nature of fund. That's why the mutual funds generally gives a diversified nature of portfolio. It takes care of the volatility that generally occurs every 2-3 years in any market conditions.
All right. But how do you address, say, the question around the overlap? Because a lot of folks say that, if I buy this fund or that fund, I usually see this around the same basket of stocks. Is it time we see more richer offerings coming from mutual fund products and also a broader base? I mean, when you look at examples, right, when say the tech boom happened, we saw the Satyams of the world entering the index, the major index, the Sensex, and you saw I think Tata Chemicals go out, if I'm not mistaken. And this is something which everyone wonders about, saying, is it time that the broader universe of companies also be explored when it comes to being stocks in a fund portfolio? What's your view of this? Are we going to see richer products coming? I think an equal weightage index fund coming out from the Aditya Birla stable. Are we seeing more richer options coming in for investors?
Yeah, I think that's something which would happen, Gautam, the sense that if you take the mutual fund product, there's a core product. The sense that if you look at the mutual fund, now gone about defining each category of funds with a large cap, multi-cap, mid-cap, and kind of fund with a clear boundary in which each funds have to operate. It has been now very well defined. 70% of the portfolio constructions have to go through the model. And then any new fund that comes in will come like a Nifty 50 equal weight index. That's something, such kind of innovation will come in order to give you an additional choice of investment opportunity that one can choose. But the way I see is in mutual fund, in any product innovation, there will always be limited scope. It's only the basket that you create, which actually is there in the existing basket of securities also. But very limited product innovation will come in the mutual fund space, except this kind of margin innovation could come. But then from customer point of view, 70 to 80% or maybe 70% of the portfolio will remain in the core traditional constructed portfolio. such as large cap, multi-cap, mid-cap, and some bit of it will come in the form of balance 30%. Unlike the way I think you mentioned about Nifty 50, equal ETF, equal index fund, equal weight index fund. Such kind of funds would come. But again, I would assume beyond a point, you will actually exhaust the opportunity of creating new fund offerings. Therefore, you come back to the core product from the point of asset allocation.
You'll always come back to the safe options. We're almost run out of time. So let me sum up the conversation around your personal view. I remember the Dear Money campaign of your parent company from a few years ago, which encouraged people to have a conversation around money. Now, if you had to ask a question to money, what would it be?
Interesting, Gautam. Of course, at the end of the day, money has to have one element of safety. It has to take care of your future needs. At the same time, you need to also have some kind of expectation on various assets in which you will make an investment in order to build a diversified portfolio. So that's why I see it from money that what it can generate. It's not about wealth alone. It's about creating a holistic experience on the money, creating wealth as well as an income. Also helps you in terms of saves your money for any emergency. So that's what I would ask the money in terms of how the asset allocation should work. And having now seen so many number of years, and this is the discipline I generally also believe that at the end of the day, you cannot chase one asset class for getting big money. It has to a combination of multiple asset class, which will give you a holistic good experience rather than good experience for some time and bad experience for some time.
All right, the holistic experience around money. On that note, let's wrap up this discussion. I guess if investing is like a box of chocolates where you never know what you're going to get, mutual funds at least give you a better chance of getting a fair share of the sweets. Hopefully, today's discussion has given you, our viewers, some food for thought when it comes to arriving at the right investment strategies and understanding which mutual fund products are better suited for your risk profile in the context of India's economic growth prospects. Thank you so much, Bala, for taking the time to speak with us here at Mutual Fund Mantras. It's been a pleasure hearing your thoughts and your insights on the themes of equities, markets, the broader India economic story. And of course, a big thank you to our viewers also for tuning in.
Thanks, Gautam, for having me part of this, and I hope it helps everyone.
Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.